Ladies and gentlemen, welcome back from lunch. Just a quick thank you to our hosts, the GIC, for inviting me. My name is Manus, Cranny. I'm from Bloomberg. Axel needs no introduction. Former president of the Bundesbank and chair of UBS. Thanks to Surif and to Deutsche Bundesbank as well. Mr. Weber, you and I have just had a conversation. That was about markets. Let's put the other hat back on now. Banking regulation. Janet Yellen, the outgoing chair of the Fed. Resilience of institutions is far more critical for the financial stability than a couple of days' volatility. Sage words indeed. Her incoming incumbent, our financial system is now stronger. Mr. Powell, he said on Monday. Mr. Weber, do you agree? Are we safer and stronger today, sir, than we were from whence you came?
Oh, absolutely. I think, and again, I don't claim this to be original, but Mark Carney, the head of the FSB, recently attested that banks have raised their capital by a factor 7. We're more resolvable. We've increased our liquidity provisions. We have much better quality capital. We're working on resolution and recovery. We at UBS, for example, have a holding company above the operating entities. We issue capital and bail-in bonds out of the holding. There is a service company that will ensure continued operation of business entities should there be a problem, and most of the legal entities are now on a more standalone basis, so it's almost like a pre-designed breakpoint. You can easily split off a legal entity or an operation or an intermediate holding company below the holding, and so banks have moved to a much safer place. Where I have some concern, because it's not all rosy, is whilst we have concentrated over 10 years of re-regulating the banking system, and in particular deposit-taking institution, we've sort of kept a very strong eye on that. We haven't really had the same focus on non-bank entities, and therefore I think there are fragilities building up in sort of what I would call market-based finance rather than shadow banking. There are some fragilities there. Many activities that used to be bank activities have migrated outside the banking system and aren't regulated in the same way that they are at banks. So there are some points regulators can't declare the all clear, but as far as the banking system is concerned, yes, much safer, much sounder, much more resilient, and much better to absorb shocks than it was in the past. And you've seen that in recent days. There was just no impact on the banking system. The system works well, and even the current volatility is easily absorbed by the banking system.
Where have we overarched or overgone? I've had lots of conversations with bank CEOs, and the gripe is, well, we don't know how much capital the regulators want us to hold. Your own regulators are a very unique, special group on their own. They want more. But have we gone too far, Axel, or is it that one goes over the breach and then comes back to a good level?
I have 2 reference points. The first one is, for us at UBS, capital strength is part of our business model. So I don't believe that having a strong capital base in the asset gathering business, in the wealth management business, is necessarily a bad thing. It is a good thing because it enhances clients' trust in the organization. The second point, and that's the reference point, is you need a level playing field. Where I am concerned is that we are now moving in different directions between the major jurisdictions. We've just seen the finishing of the Basel rules around mid-December. Most of the banks, if not all, have welcomed that better clarity. But what is now happening is, as we move from the agreed set of international rules to national implementation in jurisdictions and in legal frameworks, there will be different direction of travels. Not everything will be at the same level. And we've also seen out of the US since the start of the year quite a directional change, that some of the re-regulation actually got questioned, and we're now seeing some of that regulation being taken back. We're seeing more clarity that some of the Volcker rule, for example, some of the impacts on trading will not happen. The Treasury paper singled out the net stable funding ratio and the fundamental review of the trading book as areas where the US will revisit the impact it will have on their financial system. And I think at this point in time, it is really a moment where the European regulators and Swiss regulators really need to look at what is happening in the rest of the world in order to continue to provide a level playing field.
And you obviously mentioned the Americas, and one of the lines that's coming from the top, that's coming from the President of the United States, is about America first. And when it comes to global regulation, do you think they'll roll back that much, or do you think that they will be a little bit cautious? We've got a little bit ahead of our presumption of how much of a rollback will come from the United States.
It's not a rollback. What will happen is that some of the pipeline regulation, that was discussed but not finished will not be finished and will not come. So it's not a sort of setback. It is really, I think, a leveling off of the degree of regulation. You will see some deregulation, not just in banking, but also in other areas. And some of the most binding and stringent parts of regulation will probably be reviewed again. In particular, as regulators are now having a more balanced concern about, on the one hand side, safety and soundness of the financial system, and this is all legitimate, at the same time, at the ability of the financial system to perform its role in enabling and financing growth. And some of the regulation that we've seen have probably erred too much on the side of soundness and stability, and have really had major negative impact on the ability of the banking system to play its core role in financing credit. And that's going to be recalibrated.
You use a phrase there, the binding parts, the bits that clog up the system, bind up the system. As you talk to regulators, what are you lobbying for? What are you asking for in terms of an unbinding? What's the most pressing issue there?
Well, take, for example, if you look at capital ratios, we have hard capital, we have bail-in capital. We've issued roughly 80 billion of capital that is loss absorbing. When it comes to liquidity ratios, there are two ratios, and they are actually not consistent with one another. One is the short-term funding ratio, and the other one is the long-term net stable funding ratio. When I look at regulation, it should be regulation that reflects how we run a bank. Net stable funding ratio does not reflect how banks are run and how liquidity is managed. And so in that sense, meeting those requirements are just add-on requirements relative to the way you would do business. Take for another example, if you look at the leverage ratio, there is even cash in the leverage ratio has a capital requirement because it's your entire balance sheet relative to the risk. I think we should not lose the risk focus. People talk about how treasuries are risky and whether treasuries need a capital requirements. They already have it in the leverage ratio. So I think there are many areas where banks hold liquidity, and being liquid is important, and having emergency liquidity available at your own disposal rather than from third parties is very important. But then if that is something I want to achieve as a regulator, I shouldn't penalize it with capital requirements because it adds a burden to something that is actually good for how you run the bank. So some of these new regulations really need to be better aligned with how a bank is run. And the other part where I'm quite concerned is non-level playing field. If you get very different rules in different jurisdictions, for us as a global bank, we need the same rules almost everywhere, and that's the best way that global banking can flourish. Capital markets are global. Banking is global. You will not renationalize that, even if you have a lot of national requirements, but these national requirements need to be aligned. And that's, I think, where I've seen some reset of the balance between global banking and at the same time making more and more binding requirements at the regional or at the national level, which is really counterproductive when you run a global group.
And you have to deal with the Swiss regulator first and foremost, and I suppose to a certain extent the Swiss regulator likes to add its own top-up or its own finish on regulators, and they're usually quite heavy duty.
We call it Swiss finish, yes.
Yeah, the Swiss finish. How are you dealing with that at the moment?
Well, basically, I also sit on the Swiss Banking Association, and I sit on what is called the Brunetti Commission, which is a parliamentary commission that advises both houses of the Swiss Parliament about regulation to do. The recent discussion in Switzerland is slightly changed focus. The focus now is, let's continue to implement what is implemented in other jurisdictions, and let's just implement things that get done anywhere else in parallel. So I think to the degree that the US will not implement some of the Basel rules, Europe and Switzerland will look at that again and see whether it will then be implemented unilaterally here. If you look back for Basel II, 2 or 3 years after Basel II was agreed in Basel, the Basel Committee did and the FSB did a self-assessment and a peer review. The result of the peer review was those constituencies like Switzerland or Japan had fully implemented the Basel standard. The EU and the US were materially non-compliant with Basel rules even 4 or 5 years after their introduction. And that is a lesson that regulators have learned, that they will now look at how does regulation get implemented in national law once the rules are written in Basel, and they will look at pretty much a parallel track process rather than some constituency moving ahead and doing everything on its own and waiting for others to follow or not. So I think competition among banking systems and among major players is going to be one of the drivers on how banking regulation will get implemented. And I'm very concerned that if we don't implement things that are agreed upon as a level playing field everywhere to the same degree, that we would get fragilities in the system. Because I can tell you, we've seen it time and again, fragilities built where there is no level playing field, where there are pockets of weakness in the financial system. That's the area where the risks will migrate, and you need as much as you can have a level playing field and the same standards everywhere. That will secure resilience, not differential standards with pockets of weakness.
Can I push you a little bit and sort of say where would you say the pockets of weakness lie geographically?
Well, geographically, I think it's very hard to tell. Look, we were just a couple of weeks away from the Basel Agreement. And I think what you clearly see is that there is a question of some of the rules made outside the US, in the US, in particular when it goes, everything we hear from the Fed and from the Treasury goes in the right direction. But then when it comes to Capitol Hill, there are many senators and congressmen who say, okay, well, these are Basel rules. What leverage does that committee have over what we implement nationally? And there is a tendency, in particular when it comes to domestic players that aren't international, to look for opt-out clauses and for weaker regulation for those. And that's where I think some weaknesses could build up. For the global banks, it is an absolute minimum must that we have the same rules everywhere.
One subject that we've covered a great deal recently is MiFID. It's taken up a lot of your time. It's taken a lot of CEO's time. What will be the biggest visual consequence of MiFID? Is it going to give us more barriers to entry? I suppose that's the first point. If we start with the status quo, here we are, we're live, and it's already pieces of it are delayed. What's it going to do, Axel, to your industry in terms of barriers to entry?
So we've seen MiFID and EMIR, which are two initiatives in Europe, and they have been largely reflected in Swiss regulation, for example, for us in legislations called FINIG and FIDLEG. So those are largely equivalent regulations for Switzerland. The big question mark you now face is, as MiFID is being implemented, will that be a model where Switzerland is viewed as a constituency that roughly has the same regulation, and therefore they can apply what I call substituted compliance? That is, Swiss rules are looked at as the same rules in the EU, and if we're supervised by FINMA in Switzerland, that will give us the ability to not have a second check here in the UK, here in Germany or in the UK, and the rules of Switzerland are looked at as equivalent. However, the equivalence judgment process is one where the Commission and others reserve the right that if things aren't really viewed as equivalents, to basically limit market access. And that would be a dangerous precedent. I think you have to have some flexibility for national frameworks to reflect the kind of regulation. If you do line-by-line compliance and line-by-line comparisons of major legal texts like MiFID or EMIR in other jurisdictions, you will always come to the conclusion that things aren't equivalent. That's why I think there should be a ballpark adjustment. Is there actually substituted compliance possible? Because the rules are largely the same, and so I accept that a bank supervised under standards in Switzerland has the ability to do business in Europe and in the UK to the same degree as we in Switzerland would then accept European and UK banks in Switzerland. And I think that's the way we need to go. If this becomes a hurdle where we use these equivalent judgments to find smaller nuances that then limit your ability to have cross-border business, I think it would be a very negative development.
Many people have come in and they've said, you know, the research side could have there could be unintended consequences for research in the industry. In other words, the great and the good, like yourselves, who are cracking research analysts. I interview them all the time, big houses with big muscle, that they will dominate, and to a certain extent the boutique, which many of us have worked in and many of us have been a part of, will suffer. I mean, do you buy that argument, or is that just media hype?
No, I think that there is a real argument here, because one thing that is very clear is with MiFID you have to do a very transparent prices of what charges you have that are trading related and transaction related, and what charges you would have that are related to research or other input into a price. What we usually do when we deal with a counterparty, we give them a single price. So they basically buy a package, and that package price involves trading as it does access to research and many. Now we have to unbundle what in the past was a bundled product. As you do that, your ability to charge for elements of this unbundled product will quite strongly differ. Take the example in research. We have two research sections. One research section in the IB is macro research, top down. That will be very hard to charge clients for because there's so much competing research, including research by the IMF, by the central banks, that it's very hard to charge for that with clients. So all of the banks like us have decided we'll swallow that and simply take it into our P&L and face the cost for that. But of course, the natural consequence is over the next years, you will see research department in the major banks become very streamlined because it's a cost factor and banks are optimizing cost. There's a different research we do in the bank, which we call Evidence Lab, which is bottom-up, equity-oriented research, where we try and use big data in order to judge corporate earnings and corporate developments. That is something where even our counterparties that would not subscribe, say, to a pure research product on macro will tell us there's a value added that we see in these big data research that is bottom-up, equity research-oriented, and we continue to subscribe to that. So you will see a differentiation. Banks like us that have a strong equity focus will be able to charge for their equity-related research in addition for the transactions we do on the equity market. If you're a fixed income house and your research is largely macro, that will be much tougher. So there's going to be bifurcation in the banking community between those that can continue to charge because they're in a niche market like corporate client solutions, or those that are more in the standard fixed income business where it'd be harder. But that's an unintended consequence of MiFID. It wasn't really the design originally, but it's a consequence. And all of these regulations that are written where you don't take into account the impact and the reaction of the banks to this new regulation, in my view, should be revisited, whether they actually have unintended consequences and whether those unintended consequences are for the better of the client. I actually been a macro researcher myself from the past. I think there is a value added in having differentiated macro views and having companies and banks voice that differentiated macro views. That's how you can, for example, differentiate yourself in portfolio allocations. But MiFID is going to make that very much harder, and that's not a good development.
No, because that creates the herd mentality. That just creates one voice all singing off the same hymn sheet and perhaps leaves less room.
But it also creates financial fragility. So
okay.
If everyone is positioned on the same
as
market
we've
outlook,
seen in the recent market moves,
when we complain about recently there was a way too much complacency and everyone's outlook was more or less the same, you're going to get that if you get less diverse research, and therefore I think the risk of sort of lemming problems in the market where everyone is positioned on a similar, because you take third-party research, similar position, and then when there is a major change in the market environment and prices move, everyone has to reposition and reorganize their portfolios. It does create fragilities because it accentuates market movements and it accentuates swings in the market and causes for larger price swings in order to find a new equilibrium than you would in a diverse set of positions where people are distributed on various positions. So it does have not just a cost and an operational implications, it has a financial stability implication that in my view is counterproductive.
We've got a lot to get through in this short period of time, so let's just pick up a couple of the themes. You and I had a conversation earlier this morning. I said to you what's changed between 2007 and now. Mervyn Keane spoke to us and he said it's a different set of issues. One of the biggest issues in the crisis was bank resolution.
Yeah.
Emergency credit lines. The Europeans had to take them. Fannie went under, Freddie went under. Everybody had to take money. They tried to level that playing field in terms of the stain. But the Americans, I understand, are now hinting that they may review the ability of the state to backstop bank resolution. And I suppose that's I don't know. Is that alarming? Is that progressive? Is that the right way to go?
So go back to 2007 and to the problems we had. I remember very well when the crisis started. We actually managed for 2007 from July on, and the crisis erupted here in Germany with IKB. There are many names, Hypo Alpe Adria, Hypo Vereinsbank, most of the Landesbanks. We managed for about a year and a half almost to resolve banks by having other banks come and help the rescue. At some point after Lehman, that was no longer possible. So what did Germany do? The design of the rescue package, 500 billion at the time, was largely driven by two considerations. First, we thought that in a stress scenario, there might be an 80 billion capital requirement to recapitalize the banking system to ride out all the stresses. And we felt you need to be able to take banks off the market for 2 years, and instead of unsecured funding, which was drying up, we need to be able to finance the banks with government-subscribed and government-supported liquidity instruments. Today, you wouldn't have to do that because banks' liquidity and capital planning is such that if we had a similar or even a larger capital hit, both on the liquidity side and on the capital side, banks, the major banks, would be able to ride this out themselves. So the system is much more stable. And again, we can add stress to the last stress and the system would still be stable. The problem we had at the time was we were nowhere on resolution. We didn't have the legal instruments to basically wind down banks. Banks weren't organized in a way that they had a plan in the draw where they would simply grab their resolution and recovery submission that they renew every year now with the Fed and the major regulators and go to this plan and say, okay, here's the script on how we would want to run the bank down and sell off good parts and basically wind down at the expense of capital and shareholders some of the bad parts. That didn't exist. And if you need to invent that on the fly, you make mistakes. If you thought it through, played it through, and have the capital planning that goes along with it, you go way longer to orderly resolution. I think that's the big difference where we are now. Banks can be orderly resolved. There is no implicit guarantee, in my view, anymore for the major banks that they would have to be rescued in an idiosyncratic event at the expense of the taxpayer. There is the issue that if we were in another systemic crisis, where all of the banks would be having major issues, I think at that point in time is a question of time, how quick it gets resolved, where basically the backstops by each and every bank, if the system is infected, might call again for a systemic solution. But on an individual basis, each bank, in my view, is now much better resolvable, at least the global SIFIs are.
As you say, the plan is in the bottom drawer, and those days of policy on the fly to save the system, we've moved a long way. But if you talk about the playing field again, and I suppose to a certain extent, it's what the Americans might do for their banking system and institution. Many would say that they were further and out ahead in the initial parts of the crisis, perhaps than the European response. But how would you expect Europe to respond if the US did go down this road of hinting that no more backstops, no more state intervention? Is Europe there as well? Do you think that ability, no more bank bailout?
I think in the US what they're trying to do is provide a credible threat that if there is another problem, the taxpayer will not be the first resort, it will be the last resort of, and hopefully we will never get there.
Yeah.
In Europe, we're still planning and we're still moving. If you look at and stock market valuations of banks give you a very good example. The US banks have, about a year ago, have started to see their share prices rise. What happened? The Fed put them through several years of stress testing and at some point said, we think the banking system is stable enough, it's resilient enough, and banks can actually return capital to their shareholders because they're resilient enough to withstand stress, even severe stress. That's when shareholders understood that banks in the US will have a capital return policy. They're sufficiently capitalized to ride out any storm, and the new Basel regulation wouldn't really mean that they have to withhold earnings and raise capital. That only happened in Europe a year later, mid-December, when the first impact of the new rules was seen, and when banks like ours came out very few days later or weeks later with our earning results and gave clear guidance on what our capital return policy is and what our targeted capital levels are, understanding that we can phase in the new regulation. That still has to happen for major European banks on the continent, and it hasn't happened. And there is the issue of non-performing loans, there is the issue of sort of legal risks in banks, and I think the European EU banking system has some more way to go to get to this point that shareholders would not feel that there is another round of retaining capital and reducing balance sheet ahead. For most of the major international banks, including the Swiss bank, I think everyone understood that journey has come into an end. We have reduced our balance sheet by 2/3. We've de-risked roughly by the same amount. UBS today is a totally different bank than it was before the crisis. And for many of the European banks, they still have balance sheets that are very similar to their balance sheets immediately after the crisis. So some deleveraging still has to happen.
And that is going to take a considerable length of time.
It takes time.
And there is, there have been market stories, the differentiation between how the Spanish have dealt with their banks and how the Italians have dealt with theirs. There's an intra-disequilibrium in terms of the landscape here. You mentioned Basel again. I want to bring it back to a slightly more markets perspective. There's the rules around markets trading books, the risk models, the capital associated with those risk models. Now, that's been withdrawn for the moment at Basel. What would you like to see?
So I think what has happened in Basel is there is a limit to which you can use internal models for modeling and measuring risk, and for basically using these models for your capital requirements. You can do that to a degree, and I think the balance that was chosen was one that is different than the past one. You can less use these models, but I think we haven't moved to a place, and this is good, where you lose the risk sensitivity. If you lose risk sensitivity and you move, say, to a leverage ratio-oriented system of running banks, you're losing a lot on how banks actually run their balance sheet and how they look at risk. So I think a simple measure of balance sheet versus the risks you have, exposures relative to capital, in my view, is not how banks look at themselves. Having it as a backstop is good because it prevents excessive leverage. So the philosophy that we now have is there is a more limited ability of banks to use their internal models to fine-tune their capital requirements to those internal models, but at the same time they're not stopped from doing that. They can use it within a reasonable framework, and that reasonable framework will get phased in over a long period of time. So even the banks that aren't there yet can get there without major disruptions because they have years to re-gear their balance sheet and to raise capital. So I think overall the approach was sensible. The new dimension where I think the banking will be very important is the metric will move on. Now it's a lot more about, can banks still earn their cost of capital? Is profitability in banks such that they can have a reasonable return and dividend policy rather than just earning their cost of capital or even, not even doing that? So in the future, bank profitability will be much more a measure on how banks are looked at. To give you a simple another metric that people look at, where do you trade relative to your book value? I mean, many banks in the European Union trade below book value, some at half of book value. We in Switzerland trade at 1.5 of book value, which gives you another story that basically the market's view on how profitable a bank can be in the future is looked at more favorably by shareholders for the banks that have done their capital journey and have de-risked than for the ones where it's still ahead, because it requires another injection of capital, or some of the capital that is there will get absorbed by risks as they materialize, and that's not a good journey to be on.
No, and I do look at the RV function and compare those book values. I've hogged the stage. Do we have a Q&A in this session? I'm not 100% sure. I sort of always feel rather mean that I ask all the questions. Anybody would like to ask a question of Mr. Weber? Sir?
Hi, Uli Korch. I was just at the BIS recently, and there were some questions expressed. I was talking to a number of people, questions expressed to me as under another very serious crash if the Basel III would actually work. My question to you is, under what conditions do you think that might occur?
That the Basel framework would hold up to be resilient?
Would not hold up.
Would not hold up. Very hard to imagine that for the banking system. There is a stress scenario, because we run severe stresses. You would have to go beyond what is imagined as severe stress by our major regulators to come up with a scenario that would then violate your capital requirements. I can tell you that in our most severe stress scenarios, we don't fall under the 10% capital requirement that is there for systemic banks, and actually the minimum requirement is 7%. It's all about your loss absorbing capacity and the capital you have. So if I look at our bank, and I can only answer that question really for our bank, we're an asset gatherer. The core is wealth and asset management. The risks are not owned by us. They're risks and investments of clients. And I have a very hard time, given the much more reduced size of market risk, counterparty risk, the fact that we don't do proprietary trading and hold risk on our own books. I have a hard time imagining a severe stress scenario that would go beyond the 5 to 8% drop in GDP that are penciled into some of the regulatory scenarios. Okay, so if I give you a scenario and say a sort of 50% drop in GDP, but I think there's a lot more things that won't be standing than just the banks if you get such a severe scenario. So you come to ridiculous scenarios that I think there are scenarios under which banks would have a problem, but I think they're not in the order of what I would think a reasonable or even severely adverse scenario would look like.
Another question here.
Thank you very much for your very interesting presentation. And I have one question which you didn't mention, but it's not really natural for you to mention. I'm Hubert from Linnaeus University, by the way, from Sweden. And that is, before the eruption of the crisis in 2007-8, we didn't hear and discuss very much the issue of psychology on financial markets. There was some research done in the United States, we know that, but not very much actually, and not at central banks very much, and as far as I know. My question is, at least when it comes to short-term risks in the banking sector, is that something, behavioral finance or whatever we may call it, something you look more at today than maybe recently or before? That's something you consider more?
I think the regulators are looking at a number of areas, including behavioral finance, because it has moved from originally being a niche research area to being quite a mainstream area in economic and financial research. So, of course, it's something to look at. But a good example of recent days is actually when you talk about psychology in markets. If you look at where we were over the last year, 6 out of the 12 months last year were the lowest ever level of volatility in markets. The VIX hit 6 months in a row over the summer, an all-time low. And so you're in the 100th percentile. And when I was in Davos, I was probably among the only people that were warning that don't take this as being a normal situation. Volatility will come back. It is artificially suppressed. And when volatility comes back, it will not come back linearly and smoothly. It will come back with a vengeance. Volatility will re-erupt. And as we're seeing monetary policy, which is a main driver of markets for many years through QE, as monetary policy at the global level is starting to retreat, and as some countries, Europe first and foremost, will have a problem, unlike the US, to replace monetary policy stimulus by fiscal stimulus or sort of infrastructure programs, you will see that tailwind for markets that produced almost a 30% smooth sailing up. You will see that tailwind of markets turn into headwinds. And those headwinds will have different forces. And so I think it is not natural to assume that a 100 percentile extreme situation would continue to exist. And I think that is something where I felt in Davos, there was just way too good mood in the market. People were too complacent. I was on a panel with you, and I used 2 sentences. If you think the mood is too good, it probably is, And if you think it's too good, it probably won't last. And if it's too good to be true, it's probably not true. And I think that's what we're seeing in markets. You just need to use a bit of applied intelligence, not necessarily behavioral finance, to understand that if everyone is in a Goldilocks scenario, then probably there is a collective, misperception. And what seems, and any move in the market then, like a repricing of the 10-year treasury, will then lead to massive shifts in portfolios because people have all been positioned on the same macro outlook, and as they recalibrate their portfolios to a different sort of 10-year yield on treasuries, you change the balance between equities and treasuries, you change all of the balances of your allocation, and that does have repricing effects in the market. And the equity market's going up that long, even that small correction we have is not really a fundamental correction. I think it's a healthy correction. It takes out some of the euphoria, and it makes people understand volatility is still a risk. It's not gone. People selling low volatility, I said that about 5 times in speeches over the last year, that's about the most craziest product you can develop, because that's where you're asking for trouble, and you've seen it. Everybody that was caught by volatility shooting up, where suddenly, when they're really selling low volatility, they have to close their shorts, and that's where they really lost a lot of money. And sometimes that's a healthy thing. If people that are sort of pushing the envelope find themselves with a major loss materialization, it's a good exercise to them, but it's also a very useful lesson for everyone else that watches this unfold. So I think this was a healthy correction in the market.
It also maybe proves that these are the days when you will reach out for a piece of research, whether it's contrarian or in the middle. These are the days when you do have conversations, I presume, that try to enlighten your mind from a small boutique through to the big UBS. And this may be one of those moments when there will be evidence of the nature of MiFID and perhaps where it can be improved upon.
Absolutely. And you've seen that. I mean, there is a surge of people that now ask questions. I mean, we hear it was in our client base, it was a very orderly unwinding of positions, and people ask questions, why did this happen? Can I understand the mechanics of what accelerated the market? And then you're really at these low vola products and how they accentuated some of the behavior. Actually, it's very much the same for all of you that remember living in Switzerland when the Swiss National Bank stopped its floor for the currency that was at 120, almost like a flat line for many periods. If you look back, there was no volatility in that market because it was close to the floor. It then fell within 3 hours to 84 cents from 120. Why did that happen? It happened because most of our clients had stop losses at 119 with a clear identity that if it gets to 119, the system is abandoned. I don't know where the new equilibrium is. And then they were selling that put of 120 no longer being true. And that's where it's very hard for the other side of the market to come back. Markets need to move a long, long way before the other side of the market looks at this as a buying opportunity.
You've used a couple of phrases. Can I just ask you, the moderate disequilibrium that we've had or disruption that we've had in the past 6 days, is this the beginning of a bigger disequilibrium, Axel, or is it just a momentary reminder, a pinch to the market?
I think it's a short-term reset. I don't pencil this in as being a longer effect. If we look at where the U.S. economy is and if there are some underlying facts, the U.S. economy is, and I'm very much agree with the governor from Texas, from the Federal Reserve, the U.S. economy got a very good stimulus for the next 2 years. The fiscal program will add probably 0.5 to 3/4% growth for each of the next 2 years. The stock markets and the implication of the corporate tax reform for me mean that the stock market has another 10-15% of headroom to go over the next years. So this is a setback. This is people having woken up to 10-year treasuries being stuck at 250. As that reprices, I think people are waking up for the new the normal. That is, it's when you normalize monetary policy, it's not just the short end of the yield curve that moves and flattens the yield curve. The long end can reprice as well. That's an orderly and, in my view, a healthy repricing of the longer-term risk in the Fed funds market.
Okay, we've gone over. You'll have to ask Axel the question afterwards. He might be kind enough to answer it for you in private. We've eaten up time. Mr. Weber, thank you very much.
Thank you, Manus.
Pleasure as always.
So Ludger will receive his microphone, and it's a great pleasure for me to chair this panel. My name is Benjamin Weigert. I'm from German Bundesbank, Deutsche Bundesbank. I'm responsible for financial stability, so it's a great pleasure for me to chair a panel with the title Financial Stability and Regulation on Both Sides of the Atlantic, which seems to be a broad topic. So I try to set the stage a little bit, although I know that the panelists have they already prepared lots of thought-provoking things that definitely fit into the title, but it doesn't make it much more concise. So let me briefly set the stage for the panelists. So the global financial crisis revealed major weaknesses and fragilities in the global financial system, as well as in the regulatory and supervisory framework. One of the key learnings from the crisis is that to preserve financial stability, it needs more than sound microprudential regulation and supervision. To preserve financial stability, we also need what is now called macroprudential supervision, which is responsible for identifying system-wide risks and fragilities. So another layer of supervision. Since the crisis, we have seen major regulatory reforms, which were aimed at addressing these, the identified regulatory gaps and weaknesses. Some of them were already mentioned in the previous interview: implicit guarantees, low capitalization. We had intransparent derivatives markets, a high level of interconnectedness. And most of the reforms were coordinated at the global level, where both sides of the Atlantic played a major role. So, for example, in the Financial Stability Board, most of the reforms were coordinated, which was actually founded in 2009 to promote international financial stability. We have seen the latest conclusion of the Basel III reform package. So we also have seen the establishment of national macroprudential frameworks and authorities. In the US, it's FSOC, so another acronym, the Financial Stability Oversight Committee, which in the US is responsible for financial stability and in particular facilitating interagency dialogue. In Europe, we also have the European Systemic Risk Board, which is responsible for identifying risks at the European level. Nevertheless, macroprudential policy is a national mandate, but guided by common European principles. So, all in all, after a heavy storm, we fixed the ship, hopefully. We plugged the leaks, reorganized, hopefully, the crew and manned the crew with the right personnel. We also painted the hull in a different, maybe less fancy color. And the question now is, for most of the commentators, most of the discussion is now about, is the ship still running fast? Is it still maneuverable? Others ask, have we found all leaks? Also a question raised in the previous interview, as well as in the panel, in the first panel. Are we still guided by the same compass on both sides of the Atlantic? So that is the second major question. Do we still share the same principles when promoting financial stability and designing regulation? And the third question, which was also touched upon in the first panel, what are the challenges ahead for the financial system on both sides of the Atlantic? Especially, or in particular, because we had a long phase of low interest rates, which presumably helped to build up certain vulnerabilities and maybe systemic risks. So the question is, what are the challenges ahead, also in the interaction of monetary policy and financial stability? To answer these and more questions, hopefully from the audience, I will get you involved right from the beginning. We gathered a panel of distinguished experts in the field of regulation and financial stability. They are from 3 jurisdictions. Of course, one side of the Atlantic, the US, Sean Egan. From the UK, David Llewellyn. And from Germany, Ludger Schuknecht. Before we start with interventions of the panelists, 3 questions to the audience, which may help the panelists to see what the sentiments in the room are. So the first question is a financial state, or what do you think? Is a financial system safer today or more resilient today compared to the time before the crisis? So what is your opinion? Yes or no? Is it more resilient or not? Yes. Are you? Sorry. Is the system more resilient? Yes. Who is in favor of more resilient? Okay, supporting the case for more resilience. So overwhelming support for that. Will the regulatory pendulum swing back? Yes. Who thinks yes? Okay. And who would think if yes, it is good so? Is it okay if the pendulum swings back?
That's wrong. That's the wrong question.
I would like to ask David to start, because you're the first in the row.
Okay, thank you very much indeed. Thank you. Thank you very much. It really is a great pleasure to be here on this important conference. three immediate points of introduction and apologies. First of all, I'm in the process of losing my voice, which is bad for me, but probably good for you. Secondly, there's the usual disclaimers. It's very often the case that a speaker begins by saying, any views that I express do not necessarily represent those of views of colleagues. Can I tell you that I'm going to be more decisive than that? I can say that any views that I express are definitely not those of any organisation I'm associated with. And finally, I must say that I'm not going to say anything about Brexit. It is far too painful. I'm not a sadist, therefore I will not inflict it upon you, but neither am I a masochist. I'm not going to torture myself. Having said that, I do believe for the record that it's the most disgraceful debate, public debate we've ever had in my country on an important issue. Shall I sit down now? No, but seriously, people define a simple problem. People demand a simple solution. Nothing wrong with that, that's understandable. What is bad is that our politicians are going along with that. Simple definition of a problem, simple solution. And that is, people have never heard these days of the idea of a trade-off. We all know in politics, don't we? There are no solutions. There are only trade-offs. That's not the way that the public debate in my country is taking place. Having said that, I'm not going to say anything more about it. I also ought to say that for several years I was the chair of the banking stakeholder group of the European Banking Authority. We were a sort of consultancy agency, a consultancy arm for the European Banking Authority, and it is in that sense that I'm saying any views that I express do not represent any of those views of my former colleagues. I think what I want to say is really given in the title. If I may just give some general reflections to stand back on what has been happening and perhaps come to some view about the future. So we begin, I'm not going to go through all of these bullet points. We've had the biggest banking crisis ever, but that has also produced the biggest change in the regulatory regime that I think we've ever had. But let's be clear, it's not as if we didn't have detailed regulation before the crisis, in which case something must have gone wrong with regulation and supervision. The key issue is what? Was it a question of detail, that somehow we didn't quite get the capital and liquidity regime correct? It was a rather technical thing. We need to tidy up on that. And that's what I call the Basel N solution. Basel I, Basel II, we're moving to Basel III. There will be problems with that. Eventually, is it that we get to Basel N, which is the perfect capital regulatory regime? Or was the fault line rather more fundamental than that? And I'm going to suggest it was a combination of both. But we need to ask, what are we trying to achieve? And this is something very important that Axel Weber mentioned. I think we're trying to do two things, ultimately, and what I might call Objective 1 and Objective 2. Objective 1 I define as reducing the probability of bank failures. Capital regimes on everything that you know. We could actually reduce the probability of bank failures almost to zero. Very, very high capital ratios. 80% of bank assets must be invested in German government bonds. Well, you know. You would therefore probably have an almost perfect, stable system. You'd also have a perfectly useless system, because as Axel Weber was implying, you would actually take away from banks the basic functions that they exist for, namely risk-taking. That's what we want banks to do. Therefore, we don't want to reduce the probability to zero. Therefore, there will be bank failures in the future. So my objective 2 is how can we reduce the social costs of those bank failures that do occur, whether that be to the taxpayer, whether that be to the system generally. And here we come across the resolution regime. I mean, the resolution regime ultimately is designed to reduce the need for intervening to support failing banks and also to reduce the social cost of those bank failures that do occur. Let me leave you with a little thought on that issue, and I'll come back to it. I wonder if there is a trade-off between those two. Can we imagine an objective 2? We have resolution arrangements that reduce the social cost of any bank failure to 0. There were no costs in bank failures. Okay, this is an Alice in Wonderland idea, but nevertheless, let's just go with it. If that were the case, we wouldn't worry about bank failures, and therefore we would never need to intervene to support banks if they get into trouble. But what I'm also suggesting is that that might mean that we need to have less prescriptive, less detailed, less onerous regulation for Objective 1. After all, why have regulation for Objective 1 if in fact there's no social problem attached to a bank failure? I just leave that thought with you because it's a rather, as I say, Alice in Wonderland idea, but at least it illustrates a possible point. There may be a trade-off that the more that we are successful in our resolution arrangements, Objective 2, the less regulation we may need for Objective 1. I'll come back to that when I say a few words about the resolution regime and the like. So a few opening thoughts. The pendulum effect. Yes, there is a pendulum in regulation and always has been. We move from strict to easy to strict, and there are very good reasons for that. And one is what the psychologists call the availability heuristic, and that is that we give a disproportionate weight to the most recently observed observation. So we are too much dominated by the recent past rather than the trend of history. Could it be that we have overreacted to the banking crisis simply because, admittedly, the costs were very, very high? So I'm suggesting that there will be a pendulum effect. There will be a somewhat moving back. What I'm really going to argue, however, is not so much, if you like, the quantity or the intensity. I think it's the type of approach that we need to reconsider. So there are some very good reasons why the pendulum does exist. And let me also introduce this idea of what I've called elsewhere the endogeneity problem. And you will see the relevance of this. You all know there is a symbiotic relationship between regulation and bank business models and strategies. In other words, that bank business models are endogenous to the regulatory regime. Banks respond to the regulatory regime, but equally the regulatory regime responds to what banks are doing. So what you find there is that regulators and supervisors are always shooting at a moving target. That you've solved one problem, banks respond to that, and perhaps a different type of problem occurs, and then you have a response in the form of regulation to that. And that target is actually moving because of regulation itself. What are the implications of that? Well, I think there are limits to what regulation for Objective 1 can achieve, because the regulator will always be behind the curve, and that's not a criticism of regulators. It's almost a necessary characteristic, because banks will always respond to whatever the regulator said. It also leads to regulatory escalation, that regulation becomes bigger and bigger and bigger as banks respond to the previous regulation. I think it also means that regulation becomes excessively complex. And that will be something I'll say a few words in a moment. So the final implication for that, in my view, if I may, what we are trying to do, or what we should be trying to do, is not to optimize regulation. What we're trying to do, I think, is to optimize the regulatory regime. In other words, a combination of Objective 1 and Objective 2. Okay, a few issues for the future. Proportionality, diversity. And here is a word, the third word there. Has anybody ever used that word? And I'm going to argue that I think the Financial Stability Board and regulators ought to be using this word more and more. It should become part of the lexicon of regulation. Anthropomorphization. You probably know what that means is that we treat inanimate objects as if they were human beings, which they're not. So I'll say a few words about that. Okay, let's just... Proportionality, that was my first point. When I was chair of the Banking Stakeholder Group, we actually wrote a very lengthy report on proportionality. And what we actually found was that it's a lot more complicated, I think, than most people regard in the public debate. There's lots of reasons, lots of pressures why there is always a trend to go too far. I've got put some bullet points up there. Time is pressing. I won't go into any detail. But what I'm really arguing is it's almost a natural tendency to be disproportionate in regulation, not the least because we have, understandably, risk-averse regulators. They get the blame when things go wrong. They do not get the praise when things go right. When was the last time you read the Financial Times and the headline was, "No banks have failed this week"? You don't get that. So there is that tendency. And a few points a little bit further on proportionality. Objectives. What we actually found is that you can have a cost-benefit analysis on each and every regulation that we put forward, and that cost-benefit analysis comes out good. But has anybody done a cost-benefit analysis to the totality of regulation? It doesn't follow that just because every individual piece of regulation satisfies a cost-benefit analysis, that the totality is there. And so I'm suggesting that in many ways, in terms of costs, the total is sometimes greater than the sum of the individual parts. We also found excessive complexity in regulation, by which and I do stress the word excess complexity. Of course, if finance is a complex phenomenon, then regulation may have to be complex. We are suggesting in our report that perhaps we could achieve the same degree of protection with a much less complex system. When I put my hand up for moving back, the pendulum swinging back, it was in that element that I had in mind. I think a major aspect could be we could achieve the same objectives with much less complexity and much less cost. Oh, time is pressing. I think you know the problems of excess complexity, particularly with respect to smaller firms. Let me just come to this point. The treating of banks as if they were individuals. You see, the problem is, as you know very well, banks don't make decisions. Institutions don't make decisions. It's individuals within those institutions that make the decisions. And therefore, perhaps, what we ought to be doing is giving more focus on why banks behave in a certain way the incentive structures, the motivations within the bank, rather than what they actually do. And therefore, I think as a supervisory arrangement, we ought to be focusing rather more than in the past on internal incentive structures and culture. So that is related to my final point about culture. It's a new area of research. Some very interesting work is being done on the role of culture as affecting decision-making in financial firms. Well, culture is important. It creates business standards, influences employees' behavior. There's also a problem with regulation, because my argument would be, based on some experience I've had, if the underlying culture of a bank is hazardous, for instance, a tendency towards excess risk-taking, there's not a great deal that regulation can do to solve that problem, other than being excessively draconian in virtually stopping banks doing any risk at all. Therefore, I'd like to suggest, as my final remark, that perhaps culture ought to be part of the supervisory process. And if I may say so, we know that there is one central bank, one regulatory agency that has taken this a long way, and that is the DNB, the Netherlands National Bank, actually does have a major supervisory tool in investigating what the supervisor can do to influence the culture within an organization. I really do believe that that is a very strong way forward, because it might be that there is a perverse effect, that perhaps detailed, complex regulation may actually have a negative impact on culture, because it creates the impression all that you need to do is to tick the boxes. And providing I've ticked all of those boxes, the underlying culture of my organization doesn't work. So my last slide is, I think, a major future challenge, how to manage the interface between culture, incentive structures, regulation, and supervision. Forgive me for going on too long. I have just about survived. Thank you very much. Thank you.
Thank you. My name is Sean Egan. I'm with Egan Jones Ratings Company. Let me suggest something, and that is we're all talking about the 2007-2008 credit crisis and avoiding that again. What if you could find somebody who actually was way ahead of the curve, understood things, and expressed that early, identified what the problems were, and then was subsequently identified by a major magazine as being the leading person for warning about the credit crisis. And what if that person also disagreed with most of the people in this room? Well, basically that's what you have. I was named, they personalized it, it's really the firm, I was named the #1 person for warning about the credit crisis by Fortune magazine, A. And B, I disagree with everybody in this room, okay? In fact, I think we're more precarious now than we were prior to 2007, 2008. And I'm hoping that I convince a few people in the next, let's say, 15 or 20 minutes. That's a tall order, I know. Okay. Egan Jones, we were established in 1995. We're one of the NRSROs who are ESMA certified. We have two businesses, We started out by providing research and ratings to institutional investors, and we cover about 2,000 companies. We also have a private placement business that's mostly paid for by institutional investors. We cover about 900 companies per annum. As I said, and you can look it up, Egan Jones, number one, warned, we were identified as the number one person for warning about the credit crisis by Fortune magazine. There's numerous academic studies saying that we're early and right. We also have a strong track record, and that's reflected in hits and misses. By the way, we're an NRSRO for everything but two classes, ABS and sovereigns. So here's our hits and misses. If it's not on the website, the 2017, it will be there in a couple of days. We're pretty good at what we do. And what this measures is a convergence of the other rating firms, the other major rating firms to us. Actually, it's understated, and we do it for our own protection. We subtract 4 hits from the 4 from the hits, and we add 4 to the misses. And so the real number is not 94, it's closer to 96 or 97 for 2017. I just saw it. Okay. This is a topic of this section, identifying the problem, establishing policies to address the problem, and measuring the effectiveness of such policies and procedures. Here we are now. Policies to date, strong capitalization, increased oversight, centralizing bank oversight, and massive fines. It seems like every time you turn around, there's another $1 billion fine for some bank because they forgot to do something. I don't know what. Okay. But you know, you have to make some adjustments. You have $21 trillion. Okay, it's like who's that movie actor? You know, he said millions, and because he'd been asleep, and he said, no, not millions, it's billions. The takeoff on James Bond, but it's not billions, it's trillions. $21 trillion. I think that's worth about 1 or 2 years of global GDP. And you have ineffective checks, and I'll get into that. Identifying the problem. Okay, some people say, oh, you have to worry about banks taking too much risk. We have a more nuanced view of it. In fact, we think that it's good. Venture capital is a good business, okay? That's what has propelled a lot of growth in different areas. And you look at venture capital, and basically, if you make 10 investments, about 6 of them go bankrupt, about 3 of them are okay, and another one, if you're doing well, and another one is a home run, a grand slam home run, using a baseball analogy. So that is, in itself, that's a good business. And that one makes up for all your losses and then some. And when you make the adjustments, you're at 30+% rate of return. Okay, so if you look at it on a risk basis, they have a lot of risk. But on risk adjusted, they're fantastic. So no bad child, no bad bond. I remember when as a parent, even when my kids, I have 3 boys, when they misbehave, I said, oh, what is wrong with this child? Well, there's no bad child. It was my problem, not his. So it's no bad child, no bad bond. It's simply a misrated and mispriced bonds. The collapse, and I'll support this in a minute, occurred when the truth was discovered. Now, who looked into it? Well, probably the best study is one that was headed up by Senator Llewellyn of the U.S. Senate. And he basically said inflated ratings is right from the report. You can do a search on it. He said the report concludes that the most immediate cause of financial crisis was a July 2007 mass ratings downgrade. By the way, I replaced some names there to protect the guilty. That exposed the risky nature of mortgage-related investments that just months before the same firms had deemed as safe as treasury bills. That's not our quote, that's his. Okay. And he continues, okay, the committee continues. When sound credit ratings conflicted with collecting profitable fees, credit rating agencies chose the fees. We're different. We represent mostly investors, okay? There are different rating firms out there. We are paid primarily by institutional investors as opposed to by issuers. Massive prospective risks from, and this is the essence. I will posit that it's worse than it was in 2006. And why is that? Well, there's 3 things or 4 things coming together. Another one was just mentioned this morning. One is that you have increased indexation. I don't know what the number is, but the amount of money that's managed on an index basis or a closet index basis is absolutely massive. Okay, I know Jack Bogle. He's been a supporter of the firm for a number of years. He was a major proponent of that, for better or for worse. And I think that the amount of money just keeps growing. Look at the inflows to Vanguard and to BlackRock and to State Street, and you'll see that it's just massive. That's point one. Point two is that because of the regulation, there's reduced dealer inventories, okay? So there's nobody acting as a buffer. And three is that you have a concentration in ratings. In other words, typically for the indexes, you have 2 rating firms out there. Let me get into that. Let me address it. Okay. Now this is back, we just read this quote. The most immediate cause of the financial crisis was the July 2007 mass ratings downgrade. This is the second one, and I'll give you support for this. It says, this is from the Bloomberg Barclays Index, the biggest index out there. At least 2 of the 3 agencies need to rate a bond as investment grade to qualify it for investment grade indices. If only 2 agencies rate a security, the most conservative, lowest one is used. Now let's think about this for a second. It means that you have, I don't know, what, 45, 50, maybe 60% of the market is being managed according to the indexes. If a group of people at a rating firm, and typically it's only a small group of people, maybe 5, and it's really led by 2 people, decide, hey, listen, Wells Fargo is not the company that we thought it was. We're going to downgrade it, which is, by the way, just happened this past week. I don't know how far they downgraded, but we're going to downgrade it. And all those people, even if they thought that Wells Fargo was absolutely terrific, okay, they are forced to sell. And it's not just selling on a nice, even basis. They're forced to sell today. Today, and unfortunately, there's nobody else on the other side of the trade. Why? Because the broker-dealers don't have the inventory. Everybody else is trying to get out of the movie theater when somebody cried fire, and the exits have narrowed, okay? And furthermore, you don't even have the research that you used to before because of MiFID II and all the rest. So I would argue that it's a worse situation. And here's the index rules. You can get it. There's a reference to it. Just says what I had indicated. So basically, you have a situation where it's incredibly unbalanced, whereby, and the way it works also in the money market industry, remember, we had the good fortune of having a very strong treasurer in the form of Hank Paulson during the credit crisis, who could knock heads and get things done. What happened, just to remind everybody, is that GE could not roll over their commercial paper. Okay, it was the head of GE calling in to Vanguard and saying, please buy my paper. And Vanguard said, no, we're not going to buy your paper. I'm sorry, we're concerned about you. Okay, so it was the ex-president of GE, Jeff Immelt, okay, who's a classmate of mine, actually, as is Hank Paulson. He called in and said, please buy our paper, and Vanguard said no. Jack Brennan said, no, we're not going to do that. At that point, the U.S. Treasury guaranteed the whole money market industry. It never happened in the history, financial history, never happened at all. And we're lucky that we had Hank Paulson there. So what's going to happen now? In the money market industry, okay, people, they say there's not a buck, and but basically people think about it that way. The investors think about it that way. So if you have, let's say, a downgrade of 5 money center banks, okay, there's nobody on the other side. So the first trade gets taken off at, let's say, 10% discount. The next trade is, let's say, 20% discount. The trade after that is 40%, and there isn't any other trades after that, even though you have 4 sellers. That is a terrible, terrible situation, and that's exactly what we have right now, okay? Whether we realize it or not, that's the situation. And even if everybody in the room came up with a solution, we're still stuck. Why? Because it takes time for these things to be corrected. They say generals fight the last war. I think that the financial community fights the last war. Thank you. Okay, so basically we're in an unhealthy, terrible situation, and most people don't realize it yet. I hope that there's some reporters, don't give me credit for this. When it happens, when the next credit crisis and this sort of thing happens, hopefully you'll remember. Okay, what are some of the solutions? Okay, by the way, just to put it in perspective, this is from Fortune magazine. They said they personalized it, they shouldn't, but they did. Said to shun subprime mortgage-backed bonds while other rating agencies said these are investment grade. Okay, that's our job. We warn about Enron, we warn about WorldCom, we warn about MBIA, AMBAC. Sometimes they sue us for it, and we're big boys, we can take it, but that's our job, to tell people before they realize. Just like in this audience, I'm hoping in another 10 minutes people say, we won't have 100 people saying this is better than it was before. I think it isn't. It's worse. It's just that it hasn't been manifested yet. Okay, closing thoughts. Effective regulation is difficult, but it's critical. Thank you.
So, hello everybody. Thank you for the invitation to this conference, Benjamin, and the introduction. I'd like to focus on three things, on three areas where I think some work still needs to be done to enhance financial stability. I'll try to make some references to the US and the global situation, but mainly I will focus on Europe. While Sean, I think, left you with a sense of we are in a dangerous situation, I would share some of that in some regards, and I will come to that. But I think in terms of the lessons to draw, there's a lot we can do. So let me start with the three challenges. Perhaps the first one is only half a challenge, in the sense that, as Axel Weber was saying, and I think it's clear, in the banking area we've really done a lot in the last couple of years. There's higher capital and liquidity requirements, more capital in the system. We have functioning governance. In Europe, we have the creation of banking union with the rule book and the institutions. So I think on the banking channel, we have good achievements and a strengthened regulatory framework globally. As Axel was saying before, I do think that that the banking system is in much better shape. But and may I say, in the G20 presidency of Germany, the Bundesbank and the Finance Ministry have worked well together to bring also this agenda to a close. Not to a close, but at least forward significantly by closing Basel III, and that in cooperation with the Americans, if I may say so, and counter to what some people were fearing and claiming. But if I may point to some of the remaining problems, I mean, this one is well known. It's the large stock of sovereign debt on bank balance sheets, especially in some European countries. You see here from the magnitudes, it's actually not that small in Germany either, but in relative terms, relative to the size of banking balance sheets and to the government debt, it's particularly large in Italy, Spain, and Portugal. So this is an area where the very structure of the banking system in these countries and their balance sheets is contributing to the sovereign bank nexus. And the other issue that is always referred to is the non-performing loans, this large stock of non-performing loans, which has come down a little bit, but is still huge. I think it's still about 850 billion euros in the Eurozone. And so that, and you can see here, it is not a uniform problem across the euro area. It's a particularly grave problem in Greece and Cyprus and in some of the southern and eastern European countries. So in this regard, we do have a roadmap in Europe to bring down the non-performing loan stock, and we have a discussion on the regulatory treatment of government debt, which would contribute to also bringing down excessive exposure on that front. but on that, on the regulatory treatment on government debt, there's not much progress. And frankly, I think it's the German position, but I think it's economically also very sensible to say that we should not unilaterally favor governments, especially since in the big financial crisis, we had a couple of European countries where actually a fiscal crisis came about, and so to break the sovereign bank nexus, having less exposure to banks to government debt is very sensible. Now, in the agenda in Europe, we also have a discussion on increasing the minimum requirements for own funds and eligible liabilities, MREL, or TLAC, it's sometimes called in the international context, meaning you make banks more resilient by having more bail-inable funds. And these are important elements of an agenda which is also where there's a roadmap in Europe to then afterwards potentially discuss risk mutualization mechanisms. But if I may spend another minute or two on this topic, what do we really want to, what do we really want to prevent? And to my mind, it's forbearance. It's that, that supervisors do not address problems in banks and that they fester and grow and then potentially become systemic in the aggregate. And these incentives for forbearance, they come, of course, and they are becoming particularly problematic if there's not enough capital and so on, and if you have all this government debt on the balance sheet. But there are other elements that are not being discussed, and that, to my mind, are very important for what is called the risk reduction agenda in Europe. And this relates to accounting standards and supervisory discretion, where progress needs to be made that less of the discretion is used to, so to speak, have an unlevel playing field and privileging and delaying in the solution of problems, because this gives an incentive to banks and the expectation, you build expectations in banks that you can actually do these things and don't have to don't have to behave well, so because you may not be resolved when you should actually be resolved. There's also a number of there's also the interaction between regulation and ECB policies, especially on the supervisory side, but also on the monetary policy side. Full allotment and collateral policy and haircuts can affect incentives of banks to deal with non-performing loans if they have the possibility to put weak assets somewhere else. The easy access and long-lasting access to emergency liquidity assistance, it can become a problem here and result in zombification and forbearance. We have the question whether the very kind of nation-oriented representation in European supervisory forums is really the best setup to have a kind of euro area wide view of things and euro area perspective in supervision, or whether this may lead to collusion amongst these nationally oriented supervisors. So this is, to my mind, one needs to see this in a more systemic manner, and when we cannot simply tick the boxes on risk reduction and then say, okay, now we've done enough and now we can move to risk mutualization, because there's a lot more. There are a lot more forbearance problems and incentives than meet the eye just by looking at our risk reduction agenda. And then, if you have the possibility to pass on the cost to somebody else, you're likely to see this happen. So this forbearance issue is, to my mind, really the main remaining issue in the banking union. The second main challenge, and this, to my mind, is a more global one, and there I agree with Sean. You mentioned a lot of the diagnostic issues, and I think Axel Weber already referred to them as well. And that's the risks coming from market-based finance. And if you see where we are there in the global agenda, the global regulatory agenda, I mean, in our G20 presidency, we have agreed on, I forgot the exact term, but something like recommendations for asset management and for dealing with the winding down and treatment of CCPs, central counterparties, these clearance platforms. And when you look at them, it shows that kind of from a theoretical perspective, we've made big progress there. But actually, these are recommendations, and in many areas, operationalization has not yet taken place. Much of the operationalization would have to take place through IOSCO, and that is still in progress. So while we have made this kind of progress on the agreement of what the international standards for asset managers, for CCPs, etc., should be, the implementation and the monitoring and all that is not it has not kept pace, and so we have, to my mind, risks from the fact that we have historically low returns and risk premia, which could lead to snapbacks in the financing costs. Then, you know, you mentioned some of the things with automated trading and index-based investments, liquidity limits, etc. So when it comes to understanding risks and vulnerabilities, I talk to a lot of people in this domain, and my sense is that we don't really understand the risks, we don't understand the magnitude, we don't understand where they are. And that, I think, is a bit reminiscent of this time before the last financial crisis. So the question is whether the financial stability risks could come through these interactions. And to my mind, the G20 recommendations, if they were taken seriously and implemented, they could make a big difference. Especially as Axel Weber has said, a lot of the risk has probably migrated into this sphere. The third domain I want to touch on is public finances. We have right now the sense that it doesn't really matter how much debt and how much deficit one has. Central banks have basically made the financing of debt almost free. Bit of a change recently, but even though still there's a lot of complacency in the area of public finance, and on top of that, there is some economists convey the sense that the remaining risks can be dealt with by financial engineering. So in Europe, you do SBs and you diversify, even though there's only very limited diversification effects. Never mind, then you introduce regulatory privileges, and then you don't know what will happen with this when the market, when it's more risk off. So I want to refocus and reiterate here that for financial stability, you need solvent governments. You need governments that have buffers. Because, I mean, if despite all the efforts, to regulate, to supervise, to set the right incentives, there can always be events that may require, that at least for reputational reasons, you need to have a strong government in the background. And I always add here that I'm saying this also to protect central banks, because if governments are weak, central banks will have to step in, and they will have to step in with some variance of monetization. You may call it whatever you want, but in the end, it might be temporary, and it might be working in the sense that, it doesn't undermine credibility and so on. But the less fiscal soundness you have, the greater the risk is that ultimately it will undermine central banks. So where do we stand on this? Actually, I think it's important to note here from a global perspective that the Europeans are not in the worst place. Japan, the US, given also especially the advanced stage of the cycle in the US is in a much worse situation. Japan, well, huge debt, 250% of GDP. And then if you look at the European countries here, the situation is of course diverse. You have Spain, France, Italy. I show you debt in a second. You know, these are the three, probably the three more vulnerable countries in Europe, but in terms of deficits, in terms of flows, in terms of debt dynamics, these three countries, even these three countries are not so bad. But to my mind, you know, if you look at the level of debt, you compare 1999, 2007 with today. For the euro area, you have about 20% more debt than in 2007. But if you take out Germany, it's actually more. So we have a lot of buffer to regain. And then the US and Japan, UK is also a tricky case here. You know, if a downturn were to start tomorrow, they would be in a less safe position than 15 years ago, or 10 years ago. Now, my last slide is really is this one, and it should underpin why things in Europe are not so bad. And those who know me are perhaps a bit surprised that I say this here. But on the left, you have the expenditure dynamics in the 10 years before the financial crisis in Europe. So you had the very contained expenditure growth in Germany, less than 2%, which was below potential growth. Germany declining expenditure ratio, improving public finances. You had Italy and France, and if today we know that perhaps the sustainable expenditure growth rate is around 3%. So you see here Italy and France had also pretty high expenditure dynamics given our low potential growth. But the real outliers were the crisis countries. And their spending went through the roof, and that was partly hidden by asset price and financial boom-related revenues, so that the public finances in Ireland and Spain didn't look too bad. But now look on the right side. So you have here Germany. Last decade, the recent expenditure dynamics are much higher. They are trending towards 4% for primary expenditure. Italy and France, not bad, actually quite good. And the former crisis countries with very contained expenditure dynamics. So they have actually done what orthodox textbook public finance would tell you, that is to contain your expenditure growth, to bring your public finances back in order. And I think that is often underappreciated, that kind of progress in public finances in Europe. And so to conclude, I think we have made much progress in the banking area, but forbearance risks are still there in Europe. Market-based finance is the area to look at in the future. And on public finances, I think we have made a lot of progress in Europe, more than most people appreciate. We need to make more progress globally, and I could go into more details on this, but I think it's shown in the very contained expenditure dynamics in public finances. Thank you.
Thank you. So we've heard three speakers with with three different perspectives on the subject, and one question also to link this with the interview we've had with Axel Weber before this panel. You mentioned that regulation has changed, but culture is what culture within organization is what drives the decision-making process and so on. So my question to the panel is, have we seen the change in culture that also prevents the buildup of excessive risks in the future?
Certainly in the UK, all of the major banks now have what is called cultural reform solutions. It's a Freudian slip there, I think. And they have sort of programs that they have publicized, and nobody could possibly disagree with anything that is said, except it's all motherhood and apple pie. Of course they're going to say that. I'm not sure there is any evidence that the underlying culture really has changed.
My view. Let me take a different view of it. My view is that it's very difficult to change an organization's culture, and if the culture isn't a good fit for the environment, what happens is that the firm, whatever it is, whether it's a bank or firm, whatever, it shrinks. You also find that a culture works in one environment. Think about it. Think about one extreme. The tech bros, okay? The tech bros in Silicon Valley. I don't see any tech bros here, okay? You see them, they have T-shirts, okay? They have flip-flops, and when you talk to them, they don't look at you, okay? They look at their computer. It's true. My son funds a lot of them. He's doing very well with it, too. That culture works, okay? It works there. Why? Because there's a huge premium on thinking quickly and hitting the market before anybody else and then building out things. So my view is that it's a little bit different. My view is that we have a capital eating machine set up in the financial markets. And what I mean by that is that we set up the capital allocation process whereby if there's a problem, it blows up, okay? That there aren't any stop losses. There aren't any buyers on the other side. You have forced selling. There isn't any research. And even if you thought that this company was good, you can't keep it because of the way it's set up. The indexation is set up, and it means that you have an avalanche. Even if you had the brokers having 3 times the inventory ability that they had before, and by the way, it's not 3 times, it's about 1/3, okay, or 1/10. Even if you had that, you can't absorb the avalanche because your manager would say, no, you don't put in a bid like this. Maybe it's down 10%, but that sucker's going to go down 50% or maybe 80%. And it's forced selling. So what does that mean? Let's say there's 10% of your portfolio. The money center banks go down 10% of your portfolio, and you find out a day later that they're all trading down. It's a flash crash. They're trading down 80%, okay? So that's an 8% capital hit. The money market investors are used to, they don't want a single penny lost, okay? They always want the dollar equivalent. So that's why I say it's incredibly fragile right now, the situation. Now, what are you going to do as a fix? Well, you're not going to change indexation. It's here to stay. You can't change indexation. You can't change inventory. That's gone. The only thing that you can change realistically is the way these decisions are being made. That is, it's being made by one firm that probably has about 2 people. So the whole, when you think about it, it might be 2 people controlling whether or not the money center banks, if there's a problem, or any other sector remains investment grade. That is fundamentally unhealthy. Okay, we've talked to different people and they say, we're not going to change. We don't want to consider any other views because that's the way we do things. That is very, very dangerous when you have, let's say, 50% of the capital being allocated by maybe about 3 people. That's really what it is. And those 3 people, I call it the 2-step tyranny, where the rating might have been too high, and then the real problem when it comes down again. So they probably shouldn't have issued that rating before, but the real problem is that when it's cut, there's nobody to absorb it. So that's the core issue that is the biggest risk to the capital markets. It's a case where we're becoming very efficient but not effective. It's sort of like Henry Ford. He painted every car black because he just couldn't think of anything else. That was efficient, but it wasn't effective.
Digesting what you've said is maybe not very optimistic with regard to what the G20 did with regard to asset managers. So all the things that try to increase resilience in the asset managing sector will be more or less useless, or is it?
It's a disaster. It's a disaster waiting to happen because the blow-up can happen any place, and you have a mechanism where there's nobody on the other side. That's the essence.
Ludger.
Yeah, but I would disagree there because, as I said, we have the G20 agreements, but we don't have the implementation yet. And I think the implementation and operationalization of these agreements should deal with quite a few of those problems.
You don't have the time.
May
You
I
have about
please?
2 hours.
Yeah,
2 hours.
okay.
That's it. You have to sell by the end of the day. Forget it.
Yeah.
You know, governments work. How it takes about a year for them to even talk about
I
it.
think we are talking about different things. If I may, please
Ludger.
answer the question and comment undisturbed.
I'll behave.
Very good.
Thank you.
Thank you.
Go ahead.
Okay. So I said, I think some of the incentive problems that will lead to the kind of losses that would then be problematic. I mean, some of these losses are not problematic and they should happen, but for them to become problematic and systemic, for them the implementation of these agreements is important. And for the implementation for that, we also will not have forever. And I think it's of urgency. It's really an urgent issue in the G20, in Europe and internationally, that these things are actually being operationalized and implemented so that these things that you describe may happen, but do not have a financial stability impact.
It's all related.
Yes?
It's all related. Everything is
Please,
connected.
You're interrupting me again. But anyway, I was wanted to comment on culture as well. Because we also have differences in cultures in Europe and internationally, which will impact on the way regulation is implemented, as David has, I think, described very well. And to my mind, in a way, what does culture reflect? In the fiscal area, it clearly reflects a different perception of the importance of hard budget constraints. You know, we are much more concerned about deficits in Germany than in some other European countries. And it's the same thing in the banking and financial area, to my mind. If you're in a financial institution where you expect the government to step in, a different culture emerges. And now what happens in Europe? We need a kind of cultural convergence. And I think it is happening. It is taking place, and with the banking union, and if the Stability and Growth Pact was properly implemented, we'd also see that in the fiscal area. But I think a really disturbing element that could come here would be risk mutualization. Because if in such an environment of cultural divergence you introduce risk mutualization, you kind of reinforce the presumably bad behavior on the side of those who don't see hard budget constraints. And then, you know, you get into stereotypes, into political fights, into all kinds of things. So to my mind, that cultural divergence is another reason to be very prudent on this front.
So, implicit guarantees is a key word here. So the question is, have we made enough progress to withdraw implicit guarantees from the financial sector in general?
They're always going to...
Yeah.
Go ahead, David.
No,
Spit it out.
yeah, I pass on that one. I'm not convinced, but nevertheless.
Share your thoughts with us.
Sorry, what was specifically you're asking?
Whether we reduce the implicit guarantees and made enough progress already.
Well, I want to come back on that point to what Ludger said, and I think we might have forgotten it, because it's a very, very powerful point. One of our objectives must be to reduce intervention, to reduce the need for intervention. You talked about forbearance. My point is here, you will only be able to do that if, in fact, you come back to my objective 2, reducing the social costs of failure. Because it's only if markets and decision makers are convinced that the social costs of a bank failing are low, only then will they believe that regulators will not intervene to rescue a bank. It's no good saying we will not forbear anymore. There's no point in saying we will not intervene to rescue a bank anymore. And the reason being is it's not good enough, because I turn around and say, but you did it last time. Why should I believe that you won't do it this time?
Right.
Well, if you can reduce the social costs of not intervening, then the market will believe it. And only then.
Yeah. My view is that the people that are making the decisions will step up if they need to. Okay,
Yeah.
it's just that simple. They can say no, we're not going to support this bank or that bank. If there's a financial crisis, they simply will. And they'll make an example of some of the weaker banks, but the big banks, the important banks, they'll stand behind. And what more proof of that do you need to have than the $21 trillion that's on the central bank's asset balance sheet that wasn't there before? And by the way, I completely agree with you about the mutualization. If it does happen in Europe, that there isn't any discipline for the some of the other countries' banking system.
Yeah, and if I may add, I mean, what you're saying is of course true in a way. If we get into a really big financial crisis again, then governments will be under strong pressure to step in. But I mean, the trick should be that this next period of instability does not become so big that it becomes an issue of even like populism to step in, because in the short term, the populism is to protect the depositors and everybody. But then, of course, in the long term, this whole story turns around because it's the bailout of bankers. So how do you do that? How do you change expectations? And to my mind, the next few years, the period of good times that we have are really crucial. In the fiscal sphere, I told the Commission, you have now the chance that there is no excuse. You have now the chance to implement the Stability and Growth Pact. Nobody can tell you our conjuncture is too weak and we have skeletons in the closet or whatnot. Now you can really do it, and you start changing expectations. And in the banking, it's the same. We had the fortunate case of the Spanish bank, I forgot the name, that was kind of successfully sold off by bailing in all the subordinate debt, but no government intervention. We had the unfortunate Italian cases.
Exactly, yes.
They were, where culture comes in again, because if you have the idea to try to use every possible twist and turn in the legal system to circumvent what you agreed, you're already in trouble. But the signal going forward is problematic also, because we are not using, it was a signal that we were not using the good times to be serious. So I think that in the coming period of quiet that we are, to my mind, likely to have,
right,
we have to be tough on the cases that are there and not forbear.
Yeah, well, good
Before
luck.
you continue, I would like to get the audience involved, and I thought there were 3 questions. I would like to introduce yourself briefly and your affiliation, Volker.
I was on the program before,
But okay, don't introduce yourself.
I'm happy to talk about myself.
Forgot.
But I just have a question for Mr. Egan. I mean, so you made very forcefully this point that indexation and then kind of automaticity, something drops out, everyone has to sell. We've all invested in these index products, and so that's kind of a doom loop. But to me at least, you spent so much time on emphasizing your cause for concern that I wasn't quite sure I got the full call for action or something, what should be done. So for example, let me just comment a little bit more. So for example, me as an investor, for me as an investor, I'm very small, that's just my little savings. So all I learned is it's good to spread. So me personally, I want to spread as much as possible. So as far as I'm concerned, I don't need any limited index. I want to invest in the market, so period. So then I really don't care about whether I don't want anyone to drop out. Plus, I don't care about the ratings. And if there are 2 more, why should I care? So it seems more about regulation. So maybe some investors are regulated and they cannot do what I would like to do? So what is exactly the call you have for change?
Well,
it doesn't seem difficult.
Well, there's a few givens, okay? Indexation is not going to ebb, okay? It's already, that's point 1. Point 2 is that in the fixed income universe, the indexation is really based on 2 firms. If one of them cut, then you have to sell. Okay, so you're not going to change the rules of those indexes. Let me let me complete the thought, okay? And it might be just a few people within those firms. So those are givens. So you're also not going to control the opinions or the ratings of firms. So you're stuck. You're stuck here. Okay, the index is going to continue and grow. You're stuck with the limited, the forced selling. That's not going to change. You're not going to change the way decisions are made. The only way to change it is by making it a more robust environment on the decision-making side. That is, that you don't have just two firms, you have more than two firms that are there, and that you have different types of firms that maybe don't have the incentive to pop it up the way Senator Levin said, issue false rate, do the two-step killer, basically, where you pop it up, then pop it down. That's a capital eating machine, okay? And it affects the whole environment. Banks are not immune to that. Why? Because all of a sudden you find out you're a company and you can't roll over your commercial paper or your medium-term notes. Why? Because the markets aren't there for it, and you're turning to your bank and saying, I'm sorry, I have a liquidity problem with it, and it's all tied together. So the only thing and even if you change this, by the way, I tend to think these things take a long time to run, that using the ship analogy that you started with, that the ship is unsound right now, because even if you changed it today, it'll be probably 3 years or 2.5 years before you change the mechanism for it. So it's unsound right now, but you have to start working on it and recognize it. So you have to understand the structure. Okay. That's the key.
Erik Genen, a private shareholder of the Central Bank of Belgium. I first wanted to...
Continue. I can follow up if you don't. I can elaborate later.
I think we have to stop talking, and that is a disease which is widespread over the past financial crisis. We're still in the same financial crisis, and we're already only in a foreplay, preparing for worse. Now, what Mr. Schuknecht said about the tough talk of the central banks, and we have to set examples. And last year we had a nice situation in Italy.
Could you ask a question?
Yes.
Please.
If the European Central Bank says no more taxpayers' money to save banks, why do we keep on letting them save them in Italy?
Because it's Italy.
Well, no, I wouldn't say that. I mean, it's difficult to, in a way, create perfect regulation. And here we're in a complex landscape where there was this way out with the Italian national solvency laws. So, I mean, what the Italians did was not illegal in that sense. But I mean, it's that kind of not living up to the spirit of regulation that I think is a very but I think it's been recognized, and it wasn't popular, and my hope is that the ECB and the national supervisors involved learn from this. And I think the Bank of Italy got a lot of bad press for the preceding behavior, because before they allowed the banks to sell this subordinate debt to normal investors. So, I mean, a lot of things got out into the open, and I don't think it'll be so easy to do this again in the future, but it brings me back to the points that I made about the incentives in the system. If we do not follow up, or if we keep it to this checklist that the Commission has put out, stock of non-performing loans, 8% MREL, insolvency rule they have put in as well. And if we do not deal with the other incentive problems, if we even deny them and don't acknowledge them, I think we will continue to have these kind of problems. Maybe not to the same extent, and hopefully not to the same extent. But that's why I think we need to go further in the debate.
Yes, I have a question, please, and that is about actually something I never got an answer to. So maybe this is an experience for me that I never forget in my whole life, if you can answer the question. The point is actually, I think David brought me a little bit on the right track in that thinking, and maybe you have the answer or someone else. And the question is about banks and their standing and their position in the society. So if you look at Swedish banks, they always get, when there's a customer satisfaction rating, they are very, very low, and they do not make any progress, more or less, not at all. They had several years to improve the image in the general public by the customers, but it didn't happen. So the question is why? And secondly, does that possibly have an impact on, let's say, long-term financial stability when the customers are not really in line with the bank, so to speak? On the top of that, ready now, on the top of that, the banks are paying dividends that are about 50% of their profits nowadays, every year. And this is something the general public doesn't like either. So I would like to know a little bit about maybe you have an answer to that.
Well, I'd be very happy to answer that, but I do charge a fee for such a... but if it's free of charge, I'll be very brief on it. I'm awfully sorry, but it does come back to culture again. I mean, there is no doubt that, let me now talk about my country. There's no doubt that trust and confidence has been eroded in many financial services firms. And there are very understandable reasons for that. The banking crisis, the mis-selling of contracts that should never have been missold, the enormous fines that have been imposed. We're talking about billions of pounds of fines that have been imposed. And therefore you have to ask the question, why is it, for instance, in the mis-selling of contracts, for which there have been many, many fines, why is it that banks, or rather the salespeople within banks, actually did that? Well, it was part of the culture of the bank, which was sales-orientated rather than anything else. And the incentive structures within the banks, and I've studied this in some detail, the incentive structures in the banks was always you get bonuses by the volume of sales that you make in certain areas. Now, I think what all of that does, it sort of creeps into the mind of consumers that perhaps we cannot, and this is far too extreme, but perhaps trust and confidence has been eroded. And if you erode trust and confidence in banking, you really are in trouble, because banks can only exist with that good degree of trust and confidence in their behavior, in their solvency, and also in their expertise. When I was on a regulatory board in the UK, we actually did some research, and we found that people who lose money through making bad investments lost money due to incompetence of the financial firm and the financial advisor rather than dishonesty. So until all of these issues are dealt with, I think there is a problem. And I just sum it all up in the word culture.
But then it has some impact on financial stability, or could have it in the long run.
Yes, indeed. Yes, indeed it could.
Ludger.
No, I think there are two issues here that are important. The first one is, if you want to distract from your own faults, you vilify someone else. And I think that in the financial crisis we had a bit of that, because it wasn't just the banks. I mean, the banks responded to the framework which they were given, which was loose fiscal policies, loose monetary policies, and loose supervision in a probably not up-to-date regulatory framework. And then to vilify bankers is a bit of a cheap shot, frankly. I mean, not that some of them may not have deserved it. I've been on the supervisory board of one where they should have gotten much worse treatment. I mean, in Japan they would have thrown themselves into the sword. But anyway, the second point is that in this debate that we are leading, to my mind, we also lack sometimes a bit of sobriety and a bit of understanding what makes our market economies work. I mean, profit and the distribution of profit is the most normal thing in the world. Distribution of bonuses is the most normal thing in the world. And then we need to, and that should be acceptable conventional wisdom, but it somehow is put into question. And linked to that, we should have then a sober analysis of what the incentive problems in the system are and how we react to them, and not jump the gun on over-regulation and also emotional and social vilifying. But it's easy to proclaim this. How to actually change this, I don't know. I mean, in Germany, I would say we had this old tradition of Ordnungspolitik, which always helped to give a compass, and then you would kind of structure the discussion around it. But it's difficult to keep that up in this environment, which is very complex and difficult to understand.
Yeah. My quick answer is, how many businesses can survive when they're not satisfying their customers? And I think over time, the institution shrinks, okay, and others take its place. So it's a self-correcting problem. And back to culture, my view is that if an institution has a wrong culture or an inappropriate culture, you can put in the effort to try and change it, which is one of the most difficult things to do. Or the other ones that have a better fit of culture with the environment typically grow faster.
Before taking more questions from the audience, I would like to come back to the both sides of the Atlantic element of the title, title. We've with the new administration, there were numerous reports published by the Treasury. The FSOC also published a report, and they were all they were read, at least in Europe, as a potential for deregulation. So the question is there a different stance in policy making in the US and Europe, or is it just are they just discussing about different things? So it's about efficiency in the US, while in Europe we are still trying to make our regulatory framework effective.
Sounds like that's for me.
Yeah.
Okay. My view is that the new administration, and the new might be dropped fairly soon, has a completely different view of what is appropriate. Bear in mind that Mr. Trump is a businessman, and most businessmen believe that less regulation is better. And so I think that he is still getting his bearing, and he's a different president. You can't think of anybody who, in modern history, that is similar to him. He's sort of like Teddy Roosevelt that tweets on a regular basis. I don't. And so he says what he thinks, and most people aren't used to that. Furthermore, anything that he says will be viewed in the media differently, and he hasn't endeared himself to the media by giving out awards for what he calls fake news. So I think that the upshot is going to be a pullback from the pendulum, and you see that with the incredibly quick passage of taxation. A tax law typically takes about a decade to pass, and you wonder how in the world did he get it passed in a period of 4 months or so, even less than that. And I think it's because there's a lot of businessmen that viewed the regulatory environment as being excessive, and when they saw the opportunity to level the playing field internationally on taxation, they jumped onto it, and you're seeing some of that in different areas of regulation. So I think we're just beginning to see the start of it. What might be a game changer, however, is if the Republicans lose control of the House. And the reason why I say that is because you just need a majority of the House to impeach. Impeach is not to remove. Impeach is to just call into question somebody's behavior. That alone will just bog down the Trump presidency for 2 years. So if that's why Trump has to behave himself. If the Republicans lose control of the House, then he's going to have that sword hanging over him, and his hands will be tied.
My impression is that there is, as I said, this pendulum, that it is probably moving somewhat more quickly in the United States than in Europe, where I think in Europe we're much more entrenched to the highly rules-based regulatory system. So I think there is a difference between the two sides of the Atlantic, but perhaps there will be some convergence at some stage. Okay.
I mean, my experience with the new administration in the G20 context is that they have the new gang is very professional and very reasonable. The focus is on maintaining strong regulation and supervision of the systemically relevant institutions, and to be more or to be less burdensome on the smaller ones. Yeah. That's my impression, and that's also the declared intention. And that doesn't sound bad to me, frankly. And in Germany, I mean, if you look at developments in Europe, as David was saying, we seem to believe more in regulation in the first place, but we are also moving in all kinds of directions to more regulation. If you just look at our coalition agreement, you'll see quite an orgy of regulation in there, not just for the not so much for the financial sector, but we have more of that belief. And in that sense, I think this will lead to, if the US prioritization is really going to be like this, then it's kind of a healthy dose of competition, frankly. I think in every respect, to have a deregulating US will, in this global economic environment that we are in, is a good thing.
Perhaps what we need is a change in the regulation in the culture of regulation as well. I think it's implicit in what you said.
The question I have actually ties this together in your previous talk. I totally agree. No matter what the governments promise, when all hell breaks loose, they'll intervene. Let me turn that on its head. Is SIFI, at what point does a SIFI or a number of them, instead of becoming too big to fail, they become too big to save?
Too big to save, in other words, if their culture is, if the institution is improperly positioned, they can't do anything about it, it just muddles along, is that what you're saying?
The system, they are at that point systemically so large that in spite of the regulatory environment and theoretically they are too big to fail, at what point does one or two or three in perhaps both sides of the Atlantic suddenly become too big to save, where this all hell breaks loose, truly?
Well, as long as you, let me take a quick shot at it. Major economists had that debate as of about 3 years ago or so, or maybe 4 years ago, where they questioned whether creating money was going to cause difficulty. There's a number of economists thought that is going to cause hyperinflation, similar to Weimar Germany. That didn't happen. And it didn't happen, in my opinion, because all the major developed country central banks did it simultaneously. They had no place else to go. And I tend to think that in the case of the large, important financial, I wouldn't even say financial institutions, because it's broader than that, quite frankly. The large institutions will be saved regardless. Why? Because the central banks have already crossed the Rubicon. So even though you say, well, they should have the discipline, they have this magic wand, and this magic wand is creating currency. And it's very difficult to ignore that the thing worked in a massive way. So if there's any important institution, even beyond financial, let's say a major utility got into trouble and it threatened the service, they will step in and figuring out the pieces later, which is exactly what's happening with Fannie and Freddie as we speak. So they will continue.
But what we did is we created reserves, not money on the street.
Not the dialogue. that's left for.
But the G20 agenda was meant to deal with that in the sense that we have, these resolution plans and more capital and so on. And from what I understand, we have made good progress on that. I mean, we had countries where banks were too big to save without bringing the country in trouble. That problem should be smaller today too. What I am a bit more concerned about is, this last scenario that I portrayed, which is kind of the fiscal dominance scenario. If you have countries that are too big to save, I mean, small countries we have been saving through the ESM and the IMF, up to the size of Korea and Brazil. But I think any bigger ones could be a bit tricky, but that really requires simply better fiscal policies and more fiscal buffers. So I think, from a really systemic perspective, to me that seems the more important priority than the other one of the too big to save banks. But maybe I should ask some of the representatives at some point in private whether my optimism is correct.
We have time for one final question and hopefully final answer. You have a question? No.
As far as I know, we still living in a capitalist society, and one of the most important things in such a society is bankruptcy to keep things healthy. Now, it seems to me that we ended up in a situation that we can't take a beating anymore, that we don't have reserves to respond to serious problems, and that the only thing that we can do is to save sick entities. Do you agree with that view, or?
Well, I think you've argued that if a very, very large institution is in trouble, then there will be enormous pressure to intervene. And I want to come back to your point about, can you be too big to save? Well, let's be a little bit careful. In my country, the largest bank at the time, measured by assets, not necessarily the best one, indeed I think one of the largest banks in the world was Royal Bank of Scotland. And that became 98% owned by the taxpayer. I stress taxpayer, not the government. It's my money that they used, not the government's money. I became an owner of Royal Bank of Scotland. Now, that bank was rescued. So I'm not sure, in your terminology, what size of bank it would have to be before it becomes too big to rescue. Having said that, of course, I still would argue that we need to give a lot more thought to devising resolution regimes to actually try to avoid the very problem that you are emphasizing. The problem is, with our resolution regime, it's only just beginning. It's still to be tested in the event of a large bank getting into trouble. There'll be many, many small banks in the United States that year by year by year have failed, and the resolution regime, bad bank and bridge bank, etc., works quite well. So we, in a sense, do allow them to quote, unquote, fail. Whether it's yet to be tested in the situation of a very large institution.
We're in a very odd time of history. Actually, it's a fascinating time from an intellectual standpoint, in the sense that there is no limit to the growth of the central bank balance sheet. They can do it. Overlaying that are all the governments saying, well, we never want to go there again. We never want to build up the central bank assets. And then on the flip side, if you believe my argument, you have something where in a matter of hours, you might have a financial catastrophe. So it's fascinating in the sense that, yes, we might have the ultimate tools that we're saying we don't want to use, but we can't even put them in place because it's an incredibly fragile environment that we're getting into. So this will be the next couple years will be very interesting if some of these things that we're talking about now reach a broader audience.
But surely it's not so much the central bank's balance sheet, But the taxpayers' balance sheet.
Call what you want,
Yeah.
okay? You know, they're the ones
Yeah.
they're the ones that gave the okay.
Yeah.
You know, if you said it, wouldn't work, nor if I said it.
Thank you very much. We reached the end of the panel and also of the conference today.
So I feel we've had a good day, so let me just finish with a bit of history. So in 1976, the United States had a big celebration because it was Independence Day. And there was a group in Philadelphia who, driven by that, thought about whether it was just independence that deserved celebrating. And that's where the Global Interdependence Center started. It was a group of academics and financial community representatives who said maybe we need to consider not just independence, but interdependence. And I hope that's what we were able to accomplish for the audience today. So let me say thank you to all of the speakers. Let me say thank you to all of the distinguished guests. Thank you, Jens, for helping us get everything together. Let me thank Jill Fornito, who's in the back, who can tell you about GIC if you'd like any additional information. Thank you to Surf. Thank you to the Bundesbank for hosting. So I'll give you a few takeaways that I came away with. One, volatility doesn't seem to worry too many people here. There may be some theoretical concerns about accumulating to some sort of stress, but the volatility we've seen in the past week seems to be acceptable. There's the indexation point, but that's somewhere down the road, we would guess. Maybe this is because the banking system is soon to be unbound. Maybe that can help finance the economy as long as we have risk-focused policy and a level playing field. Some banks have completed their capital journey. Learned that today. Maybe with the stress scenarios easing a bit in some of these tests, or at least the bank's able to pass the strict ones, there's room to go. So I wouldn't be surprised if we hear more talk about something we haven't considered for a while, which is the velocity of money. Maybe we'll hear that starting to pick up, which has not happened really for decades here. We also learned output gaps could be closing or closed in some cases. The U.S. economy could be at full employment. We can't push the unemployment rate down and down and down without seeing some consequences. Unemployment could have a 3 handle in the U.S. by the end of the year. And the Phillips curve seems to work in Germany, so maybe there is some evidence that we can port that over. In that environment, our star could be positive, and we should at least think about getting short-term rates to the inflation target, or at least the inflation number, getting out of the zero real rate environment. On fiscal stimulus, it seemed like we had some mixed opinions. Maybe we need to revise down expectations of fiscal stimulus, or at least consider the transmission channel if it needs to be something other than investment to get a 0.5% to 0.75% boost, as was mentioned. Maybe the next survey from the Atlanta Fed can give us some insight into how businesses are acting. We'll watch for that to be released. An additional item could be government spending outside the tax bill. So maybe fiscal stimulus in the U.S. is going to wind up broader than just taxes. Maybe it's going to include government spending. We saw that just in the last few days. We discussed some structural issues, demographics, the skills gap, government leverage being 3 primary ones. Maybe the German middle-sized company model, the Mittelstand, can help us think about what we could do globally. We talked about fragilities in market-based finance, things that used to be in the banking system but are now outside the banking system. Maybe that's money market funds, maybe that's index bond funds. But at least the VIX volatility of the last few days has been absorbed by the banking system. So we'll see how this plays out. We learned that the ECB will likely take the Fed's experience and learn from it. That can help going forward. We know we have some momentum in global economies. We know we have momentum particularly in France. Maybe we can't get euro bonds, but some banking security union or euro deposit guarantee system is helpful. And finally, we learned that if something ends in markets, it ends badly. And so I don't want this conference to end badly. So let me just say thank you. I appreciate everyone coming and participating. There will be, as a housekeeping item, a bus to the guest house at 5:30, and that will be downstairs. In the meantime, I think I'm going to go look up how to spell anthropomorphize, and maybe watch out for the capital eating machine. So, thank you very much.